This entire podcast is AI generated. The conversation, the script, and all three voices you're hearing were created using AI. I'm Milan, and I'm here with Elias and Zane. It's just wild, isn't it? These Q1 earnings from Microsoft, Meta, Alphabet, and Amazon, they all beat expectations, which is great. But the absolute elephant in the room is this AI capital expenditure. I mean, we're talking about hyperscalers guiding toward a combined $650 to $720 billion in Capex for 2026, with Amazon alone nearing $200 billion. Morgan Stanley, in their mid-April analysis, really zeroed in on the growing chasm between this massive spend and actual, tangible monetization right now. Are we at an inflection point, or is this the biggest Capex bubble ever?
That $200 billion Amazon number is the part that makes me sit up. Because once one company gets that aggressive, the rest of the group can't really pretend this is just routine maintenance anymore. The Q1 beats matter, sure, but they only buy patience if the next few quarters show actual margin lift from AI, not just prettier Capex charts. Apple tomorrow feels like the last clean read on whether consumers are still willing to pay up for the ecosystem, or whether we're all just funding a very expensive build-out.
What's wild is Amazon's free cash flow just collapsed to $1.2 billion over the trailing 12 months, down 95% year over year because of this AI build-out, and investors barely flinched because AWS came in at $37.6 billion in revenue with 28% growth. That acceleration is the only thing buying Amazon time to justify pouring another $200 billion into this. But it's basically a bet that they can keep growing faster than they're burning through capital.
That $1.2 billion free cash flow number is the thing, because it says Amazon isn't just spending, it's swallowing the balance sheet to keep the AI race from running away from them. The part I can't shake is that AWS still has the 28% growth to hide behind, but if that starts slowing before the Capex pays back, the whole temporary digestion story gets ugly fast. Apple tomorrow is going to tell us whether this is still a broad demand cycle or just the hyperscalers talking to themselves.
The thing that's getting glossed over is that Amazon's quarterly Capex just hit $44 billion. That's almost double what they spent in Q1 last year, and they had to book a $16 billion gain from their Anthropic stake just to keep net income looking respectable. Their chips business is doing $20 billion annual run rate now, which is impressive, but if that custom silicon bet doesn't pan out and they're stuck paying NVIDIA full freight, the whole payback timeline gets ugly.
That $44 billion in one quarter is the kind of number that stops sounding like spending and starts sounding like a strategic dare. Amazon's got the AWS growth to defend it for now, and that's why the market isn't panicking. But if they're still doing this when that growth cools, the story changes fast. Apple tomorrow is the real sanity check on whether this is broad demand or just the cloud giants talking to each other.
Strategic dare is exactly right, but it also feels like a full-blown commitment to vertical integration they've been building for years. I was just reading a piece last week, probably in The Information, that AWS is really betting hard on their next-gen Inferentia 3 chips to undercut NVIDIA on inference costs for big enterprise clients. If they can make those custom silicon bets pay off on a massive scale, it might actually justify some of this staggering Capex. But that's a big if when we're talking about $200 billion for Amazon alone, isn't it? It feels like the market's just holding its breath.
That Inferentia 3 angle is the only way this doesn't turn into a pure spending race. Because if AWS can keep pulling inference off NVIDIA, then the Capex has a self-contained payoff instead of just feeding someone else's margins. But the thing I press on is whether vertical integration is an efficiency story or just a control story. Those aren't the same. If Apple tomorrow is soft, this whole group might be building for an AI demand curve that hasn't really shown up yet.
That distinction between vertical integration as an efficiency versus a control story is really sharp, Zane. But when you see Amazon's latest move, like that Anthropic deal announced just this month, Anthropic committing over $100 billion for AWS's custom silicon for Claude over the next decade, it honestly feels like a massive validation. Andy Jassy even mentioned their chip business is already doing $20 billion in annualized revenue. That's not just about control. That's concrete monetization and demand, right? It suggests the AI demand curve is definitely showing up.
That's the part I'd push back on. The validation matters, but a 10-year, $100+ billion commitment from Anthropic can also be read as lock-in, not proof of broad demand. Amazon saying its chips business is already over a $20 billion run rate is real, but that still leaves the bigger question. Are they monetizing AI at high margin, or just converting Capex into strategic gravity? If Apple's tone tomorrow is cautious, I think this turns from efficiency story into control story pretty fast.
I mean, the lock-in reading isn't totally wrong, but Anthropic just disclosed their run rate revenue hit $30 billion annualized, up from $9 billion at the end of last year. That kind of customer traction doesn't really happen if the underlying product is just cloud dependency theater. They're saying demand's straining their infrastructure so hard it's hitting reliability during peak hours. And that's the kind of pain you actually want to see if Capex is supposed to chase revenue.
That $30 billion annualized number from Anthropic is the first thing in this whole debate that feels less like a slide and more like a real business. Because if that demand is genuine, the spend isn't just speculative anymore. It's being pulled through by customers. But I still don't think it settles anything on its own, because fast run rate growth can coexist with ugly unit economics for a long time. And Apple tomorrow is going to tell us whether the broader premium consumer is still opening its wallet or whether this AI money is mostly circling inside the cloud stack.
Yeah, but OpenAI's pushing back hard on that $30 billion figure, saying Anthropic's overstating by about $8 billion because of how they're counting cloud partner revenue. If you net it out the way OpenAI wants, they're actually still ahead. The deeper thing, though, is Anthropic's got over 1,000 enterprise customers, now spending more than $1 million a year, which doubled in under 2 months. And that's the kind of traction that makes all this AWS and Google Capex look way less speculative.
That pushback on Anthropic's $30 billion run rate is the right fight to have, because if you're counting cloud pass-through and partner dollars as revenue, the whole scoreboard gets slippery fast. What's harder to dismiss is the real demand underneath it. Over 1,000 customers spending $1 million+ a year is not fake smoke. But it still doesn't answer the ugly question of who's going to earn the margin after all this Capex gets buried. Tomorrow's Apple print might matter less for spend and more for whether the premium consumer is still showing up.
Yeah, Anthropic's defense is that they're the principal in those transactions, which under standard accounting does let you book gross revenue. Both companies use different treatments for cloud partner revenue, and honestly, it probably won't get settled till both file IPO docs later this year. What matters more to me is the durability question. 80% of Anthropic's revenue is enterprise API versus OpenAI's 60% consumer mix. And if that holds through a downturn, the accounting fight becomes noise.
That principal versus agent point from Anthropic is exactly where the accounting gets slippery. Because if they're truly the principal, then gross booking is fine. But the market still cares whether that revenue is really theirs to keep after the cloud pass-through. And I think Elias is right that the enterprise mix matters more than the headline number. Because if 80% is API and sticky, then this isn't just a consumer hype loop. Apple tomorrow should tell us whether the demand story is broadening or still trapped inside the infrastructure trade.
That principal versus agent accounting point is definitely where things get murky, Zane. And the market absolutely needs clarity on who's actually holding the bag. But what I'm seeing, like in a recent analyst note from Baird in mid-April, is that the sheer scale of enterprise AI adoption, especially across verticals like financial services, is starting to create tangible, high-margin revenue streams that go beyond just cloud pass-through. It suggests the demand side is finally catching up, making the immediate accounting nuance less critical than the long-term economic upside.
Milan, the thing about principal versus agent isn't just accounting nerd stuff. It's whether the revenue is actually sticky or just being routed through the pipes. I get the Baird-style optimism, but if this quarter's big numbers are being powered by a handful of giant buildouts and a lot of pass-through economics, that's not the same as durable, high-margin AI cash flow. Apple tomorrow matters because if consumer demand is soft, the whole market's going to stop pretending this spend is already paying for itself.
That principal versus agent accounting point is definitely where things get murky, Zane. And the market absolutely needs clarity on who's actually holding the bag. But what I'm seeing, like in Microsoft's Q1 earnings call last week, is Satya Nadella highlighting that Copilot for Microsoft 365 now has over 1.6 million paying enterprise seats, hitting a $2.5 billion annualized run rate. That's not just cloud pass-through, that's direct, high-margin software revenue showing tangible monetization, making the accounting nuance less critical than the economic upside.
That 1.6 million Copilot seats is the right kind of number to drag this out of abstraction. But it still doesn't answer the bigger question on April 29th. Does it scale fast enough to outrun the spend? Microsoft's own results today showed the AI business at a $37 billion run rate, which is real. But if that's the best proof point, the whole Mag 7 story is still mostly about proving payback, not declaring victory. Apple tomorrow probably tells us whether this is broad demand or just enterprise budgets getting front-loaded.
The actual number Microsoft just disclosed is 20 million paid Copilot seats, not 1.6 million. And that's up from 15 million in January, which is a 33% jump in 3 months. Nadella said weekly engagements at Outlook levels now, which if true is a massive shift in adoption behavior and exactly the kind of stickiness Microsoft needs to make the spend payback story believable.
That 20 million Copilot seat number is the first one that actually feels like a product, not just a PowerPoint splash. And that's why Microsoft keeps getting the benefit of the doubt. But I don't think it settles the Capex question at all. It just says adoption is real, not that the margin profile is already healed. The dangerous part is everyone's now got enough proof to keep spending, which is how a boom starts sounding like discipline right before it stops being one.
The thing is, Microsoft also just restructured their OpenAI deal 2 days ago, so they're no longer paying revenue share out. OpenAI keeps paying Microsoft through 2030, but now there's a total cap on it, which basically locks in margin upside as Copilot scales without bleeding back to OpenAI. That 20 million seat number's only convincing if the unit economics actually improve from here. And that deal change is the first real signal they're prioritizing capture over partnership tax.
That Microsoft OpenAI deal restructure Elias just mentioned, announced just 2 days ago on April 27th, really shifts the whole dynamic, doesn't it? Microsoft no longer paying a revenue share to OpenAI, but OpenAI still paying Microsoft with a total cap. It seems to clarify some of that margin ambiguity we were talking about, giving Microsoft more predictable upside from Copilot's 20 million seats without the open-ended bleed to OpenAI. It's a pragmatic move to secure that internal monetization.
That April 27 Microsoft OpenAI reset is the cleanest tell in this whole mess, because Microsoft just turned partner tax into capped economics and kept the upside on its own side of the table. So the Copilot seat growth matters more now. 20 million seats is real, but I'm still watching whether that translates into operating leverage, not just bigger AI traffic. If Apple's print tomorrow is even a little soft, this starts looking less like an inflection point and more like everybody buying time.
The big thing everyone's missing is that OpenAI now gets to sell on any cloud. So Microsoft just traded exclusive margin lock for a capped payment stream that ends in 2030. The actual financial win is Microsoft no longer bleeding rev share on Azure resell, but they also just handed their biggest AI asset permission to boost Amazon and Google's Capex story. That's not pure margin capture. That's a defensive retreat dressed up as flexibility.
That Microsoft OpenAI reset on April 27 is the real tell, because any cloud doesn't sound like a moat so much as OpenAI admitting the distribution game is wider than one vendor. It's smart for Microsoft to cap the bleed and keep the upside on Copilot, but Elias is right that it also hands Amazon and Google a fresh excuse to keep spending. This is starting to look less like victory and more like everybody racing to own the plumbing before the bill comes due.
You know, it really feels like we landed on this idea that the AI CapEx boom, while showing glimmers of real adoption like Copilot's 20 million seats, is still fundamentally a race to build the infrastructure. And whether that infrastructure leads to truly high-margin, widespread monetization, or just a very expensive game of control, is still totally up in the air. We'll have to keep watching. Big thanks to Elias and Zane for breaking it all down with me today. That's it for this one. Until next time.